Well, gentlemen, thank you so much for joining us. And like I said, the topic is from insight to impact, the top-down, bottom-up approach to employee wellness. And I'll start with you, Geoff. From your perspective, what is the biggest challenge that employees are facing today?
Maybe just before I answer that, I'll say I'm doing the top-down, he's doing the bottom-up.
Okay, all right, we got that.
We're sister companies. NMG Benefits is an employee benefits business. EmpowerFin, which Hambisani is the CEO and founder of, is a financial wellness business. So we bring different perspectives to this. Mm-hmm. In answer to your question, I would say it's simple. Crushing debt. Not AI, although that's obviously an issue for the future. But, some of the... I should disclaim I'm an actuary and hence a numbers nerd and hence statistics, but I'll try not to throw too many of them out. Mm-hmm. 60 billion, that's the amount of two-pot savings pot claims that have taken place since 1st of September last year. Yeah. It's shocking, right? It's a really bad idea to take money out of your savings pot. You trigger tax at marginal rate, et cetera, And what we see all the time is employees making very bad decisions about their financial future, very short-term decisions, and it all points to this desperation that they've.
Oh, we can't hear.
Oh,
okay. Can we just get the technical team? Either a handheld mic.
Is that better?
Is it better?
I'm not doing anything. I'll try not to move in that case. But yes, coming back to the point that, what we see all the time is employees facing tremendous pressure from a financial perspective. And that obviously has to impact everything else they do, the decisions they make. So I talked about the 60 billion in two-pot savings pot withdrawals that have taken place. Mm-hmm. But there's lots of other evidence. I think everybody here would be familiar with employees coming and wanting an advance against their salary. A lot of these payday advance schemes are actually extremely expensive in either interest rates or in fees, and it's expensive. The short-term unsecured credit, very expensive. So we do see a lot of bad decisions being taken in the context of a scenario in which there is one job for every 5 citizens in this country. Mm. So we have to recognize that as well. 12 million people are in the formally employed workforce. The average salary in South Africa is 22,500 Rand a month. But that's very misleading. That's the arithmetic average. Again, numbers nerd. The median, which means half of all people earn less and half of all people earn more, is just over 5,000.
Sure.
So we have some very high earners in South Africa that pulls up that average. But half of all the formally employed people in this country are earning less than 5,500 Rand a month. When you impose all the pressures that they face, as I said, the 5 citizens that rely on that salary, you can see what the number one issue for employees is in South Africa. I'll just pop on to the next. So Hambisani?
So, Hambisani, he speaks about, so Geoff spoke about debt, right? And the fact that employees would take like the two-pot system and take out their savings too early on. Why do you think that they're facing these challenges, and how important is it as an organization to actually help them out in this case?
Yeah, thanks, Mokwena. I think it's quite clear from the work that we do that the problem is quite systemic or structural. And I'll give some bit of context here. FNB issued a report sometime last year. In that report, what came out and it was quite troubling. They said when they looked at the low to middle income earners that bank with them, 80% of those customers spend 80% of their salary within the first 5 days.
Ooh.
Let me repeat that stat. 80% of those customers spend 80% of their salaries within the first 5 days.
Sure.
Right? Now, this is revealing of something of a crisis. Mm. Now, if you take a step back and you consider the credit landscape, one of the things that come out there is if an employer or consumer is taking out a short-term loan as per the National Credit Act, lenders have been allowed to price that loan. Just interest rate alone, they're allowed to charge 5% per month or 60% annualized. That is before initiation fee, service fee, and credit life. Once you add those other sets of fees, the total cost of credit on a short-term loan is easily north of 90% effectively. And if it is a non-short-term loan, and you analyze that pricing structure, the total cost of credit comes up easily north of 60%, right? Park that. Consider how they are then charging, for instance, for insurance that is embedded within those loans. You find a situation where an employee takes out a loan of 100,000 rands over a course of 4 years. On day one, included in the installment would be 450 rands for the insurance to cover them in the event of retrenchment, death, or disability.
Sure.
Come month 36 of the same loan, when the balance is now 5,000 rands, they are still paying 450 rands for the same amount of insurance, which is not commensurate with the risk being covered. You park that. You then consider the exploitation they're being subjected to when you consider how much they are paying for funeral policies, for instance. Yeah. When you then take into account the totality of these abuses, it then clearly presents a picture that employees are truly under siege. It is no wonder how then you are seeing this manifesting itself in the employer environment through lack of productivity, through employees that are not disengaged, because this attack they are under is something that is fueling this pandemic of employee financial distress.
I like the fact that you spoke about how this now affects how they perform in the workplace. And I want you to go just a little bit deeper into that and how now I'm earning, let's say I'm earning 5,500 Rand, right? I am the breadwinner. And within 5 days, I've used up 90% of my money, just like Hambisani said. I come back to work. How many more days do I still have? About 20 plus days still to go on nothing. And how does that affect the performance of an employee?
Yeah, I think you've painted the picture quite nicely, and maybe before I respond pointedly to that question, let's also beginning to consider the role of the employer in this. Yeah. To be fair, employers are alive to this as a problem statement. And to their credit, most employers, because they are responsible, they've then went to find solutions to this problem. But in the absence of properly diagnosing this problem, whatever solution that you're going to come up with, notwithstanding the fact that your intentions were good, 90% of the time what we've seen is that solution, instead of solving for the problem, actually exacerbates the problem. I'll make you a practical example, and I want to lead from the question that you've put to me. Now, and referencing that study from FNB, in the first 5 days, 80% of the salary has been depleted. The question is, how does the employee then survive and make ends for the remainder of the month? You find employers having allowed into the environment this new phenomenon called early wage access, right? Which is meant to allow employees that as they earn a portion of their salary, they're then able to access it. But what these employers are missing is when you begin to scrutinize and analyze the fee structure of such proposition, it is no different from some of the fees, the extortionate fees that employees have been subjected to with these microloans that I alluded to earlier. So the point is, in the absence of, number one, properly understanding and diagnosing the problem, notwithstanding how well-meaning employers are, some of those solutions begin to miss the mark. And then, to your point more pointedly, when employees then begin to find themselves in that situation, that's when you start seeing exponential increases in absenteeism. Actually, we recently did an analysis for one of those employers. I know I'm talking too much, Geoff. No, I'm quite passionate about this, clearly. And part of the analysis, right, that we did for this employer, we're then able to give them a snapshot view to say, based on your employees, we're then able to unpack which creditors are the top 5 suppliers of unsecured lending to their employees. So creditor number 1 comes up. I won't say the name, of course. The amount of loans that they had supplied to this employee base that was active at the time was currently sitting at 198 million rands. When we then analyzed the effective total cost of credit on this book, it was 68%. Now think about this for a second. Employees with exposure, active exposure of 168 million rands, with an effective total cost of credit of 68%. And I'm no actuary, Geoff is, right? Notwithstanding me, spitting out these numbers. You can then begin to appreciate that such an attack on their finances and how it's translating and manifesting itself in terms of poor productivity. So for that employee in particular, we're then able to isolate which employers were worstly affected, referencing a particular department.
Yeah.
And the employer was able to correlate that with some of the payroll information in terms of absenteeism. So to summarize my response to you, I think it is quite clear that this distress that employees find themselves in does, manifest itself in a manner where it's reducing productivity, it's increasing absenteeism, and all these features that are not optimal for proper performance by the part of the employees.
I mean, maybe just to add to that, the slide that's up there is a very high-level summary of a standard analysis that we do together at our clients. And this is by no means an outlier. That just happens to be a fairly recent one with an employer of roughly 3,000 employees in the healthcare sector, so quite well-paid employees. But 55% of them are in arrears on their this unsecured credit. It's particularly there. The secured credit, the housing loans, the car loans are much less likely to be where the problems come. Now, Hambisani, 55% of the workforce of this client being in arrears. Does that shock you?
Well, when you consider some of the structural challenges, it's something that we actually see quite often, Actually, in the past 8, what we call these anonymized employee diagnoses, because we're able to paint this picture on an anonymized basis. 60% of the last employers that we did this analysis for, over 50% of the employee cohort exhibited similar characteristics. So absolutely, Geoff, it's something that we see quite often.
Yeah, and in this case, the average employee is sitting with 50,000 rand of debt.
Sure.
That they're behind in, just to be clear. That they're behind
in.
That they're behind in. So it is a real burning issue at the workforce. I just want to flick to the next slide very quickly. And this is the reality versus the theory. We all know what employees should be doing, but they're behaving very differently to what they should be doing. We know they should be saving for their retirement. They're not. They're taking money out anytime they can. We know they should be, etc. This is a study that our international consulting business does of consumers, and they do it in South Africa as well. And they look at what's really important in the financial sector to consumers of financial products. And you'll see there the priorities. Funeral cover number 1. Right, the funeral insurance market in South Africa is massive. 60 billion rand of individual funeral insurance premiums paid out each year. 15 billion of that is first-year premiums, and the lapse rate, that means the policies that don't make it to their second anniversary because people stop paying, is over 60%. The amount of waste in that, the money is showing that this is a really high priority for people. That's why they're spending the money. But so much of that is wasted because of the way in which funeral insurance policies are sold, the way in which they're oversold and missold to these employees. Savings and investments, education. You see health insurance coming there as number 4, some form of health insurance, whether it's medical aid, medical insurance. It comes in only as like the 4th highest priority within the financial framework. It does increase as the salaries go up. But, this is what we're wrestling with, is that actually people are deciding and making decisions based on their circumstances, their preferences. And of course, we have to reflect that. The last slide we have. Oh, sorry, you want to ask a question?
Yes, I do. I can tell how very passionate both of you are about this topic. I just do want to ask, and I'm sure it might also be encapsulated in the slides that you have. What can organizations then do to help their employees to navigate these issues?
So Hambisani is the guy who's going to tell you how they fix it. I'll tell you about the diagnosis.
Okay.
So
give us a diagnosis.
Well, and the part of the diagnosis is when we talk about top-down or bottom-up. We've developed a thing called a well-being index, it's something we work with our clients on, and it's unique to that company. So what is the well-being of your staff? And we look at physical well-being, health. We look at mental well-being, very important. We look at workplace impact. Hambisani talked about absenteeism, etc. And we look at financial well-being. And we calculate each of that. We get information from the medical scheme, the insurers, the EAP, payroll, etc. And we distill this into a well-being index. And that gives you a number, and you can see how that moves from year to year. And that, it's a discussion point, and you can identify. Interestingly, of those 4 elements to the well-being index, the one where you have the most levers, the one that you can impact the most, is the financial well-being.
Okay.
Takes a lot longer to impact mental health and physical health. The other thing we do is bottom up. We do analyses, we do staff surveys. So we always experiment on our own employees. There's about 1,000 between our companies. And we did the survey, and we asked them a bunch of questions about what's going on in your life. And we asked them a bit of a trick question. We said, I'll give you 1,000 Rand today. How much must I give you in 12 months' time for you to take that instead? And we start by saying 1,500 Rand. And as soon as somebody says, no, I'd rather have 1,000 Rand today than 1,500 Rand in a year's time, we then iterate to see what's the ambivalence point. 3,500 Rand. That's what our employees would have to get in 12 months' time to give up 1,000 today. That makes no sense, okay? It is irrational from any kind of a logical or financial perspective, but that tells you the pressure that they're under. So in terms of solutions, Hambisani, apart from just paying your guys more.
Yeah. Look, I think for me, the starting point is, and I think I alluded to this earlier, is employers taking a step back and allowing for a proper assessment or diagnosis to be performed. Because when you rush into implementing any proposition, regardless who's the player or the service provider that is placed on the table, in the absence of that proposition being implemented against a proper diagnosis being done, you're going to find that you're going to easily find yourself in a position where the impact of that proposition tends to be counterproductive, and we've seen this. I alluded to the fact earlier that in trying to solve for this problem, employers are even bringing in service providers that exacerbate the very same problem that we're trying to solve for. We've seen instances where employers, once again, well-meaning, trying to solve for this issue of employee financial distress, bring through onto payroll credit providers that do consolidation loans at the very same maximum NCA rates, where effectively employees are paying on average 63% total cost of credit. And this is what happens when employers just rush to find solutions. So before I even speak of solutions, I think for me, what I'd like to place on the table is a parting shot. It's welcome employers to say, let's walk that journey of assisting to diagnose what is the problem with your particular workforce. And through this collaboration we've got with NMG, that assessment or that diagnosis that we do with employers in the form of that anonymized employee diagnosis, accompanied by these bottom-up employee surveys, it is something that we do at absolutely no cost, So let that be the starting point, because then once we've been able to place on the table how the picture looks like for your particular workforce, it is then that we can then start saying, what solutions can we deploy that will then be able to make measurable impact on this properly defined problem statement. So I think that's where I'd love to leave it, at least for today on my part.
All right. For the last question on this, would it mean that as part of the solutions, is it more pay? Or are there other ways to help the employees? Because sometimes it might not just be a more pay situation where they'll still find themselves in the same financial crisis. But are there things that as an organization, as human resources, they can implement practically? Maybe one idea or two ideas that you can actually give them just to start off.
Last 30 seconds from my part, it's not necessarily more pay. I think there are solutions, when properly designed, they could give the same outcome as if the employer has facilitated a rise in their wages or salaries. And it's around solutions that properly optimize the current position of an employee. So it's not necessarily more pay. You may find, as I alluded to some of those examples, where employees are charged in a very inappropriate manner when it comes to credit life. A solution to optimize on that would, for instance, be a credit life replacement proposition that then say, employee, right now you've just been taken advantage of, as opposed to paying 800 rands per month on this policy. Here's an alternative that, you pay 200. There's a monthly relief of 600 rands per month projected over the remaining term. It's quite substantial. So the answer is not necessarily trying to get employers to pay more. It's about first, and I go back to this as we've got the last 25 seconds.
Yes.
Let's define the problem statement. And the outcome of that diagnosis will then say, what solutions can we deploy to optimize and therefore create cash flow relief for employees?